where better to start than with the US dollar? It's supposed to be the world's reserve currency, still is to this day. But we're seeing a sharp decrease. It's actually an 8.42% drop in a very short period of time on the dollar. Anybody that can understand a trend sees that the dollar has been increasing in value relative to a basket of other nation state currencies since the 2008 bottom, effectively. But every time you see a big spike down, like in the past, like sometime in '09 and let's see, when was this? In 2017, 18, these big spikes down, they have follow through. So what this is telling me is that money is leaving dollars and it's going to go somewhere. So what our job is we're trying to figure out, well, where is the money going? If it's leaving dollars, where is it going? So I have here on the left that there's 23 days left until this monthly candle closes. It's just a tiny little candle. It's pushing up against this upper mid band of this channel. And the question is, does it make a spike higher? Does it go lower? What does it do? Well, only way to know is to go check out what other asset classes the money's going into. So these moves generally have follow through. They're characterized by money moving into defensive positions such as gold or US bonds. So price is attempting to catch that support on that band. So here I have a couple other, I guess fractals. They're old fractals from in the past that when the dollar does these 8% breaks, this is the kind of patterns we can expect to see. It's sort of a fractal forecast with a little bit of a time frame. So in yellow, let's make some hypothetical situations where the dollar does certain things under certain fundamental conditions. Let's say the dollar reverses here, bounces off this level, goes up and tests the 109 level or to the 112 level, somewhere in there by the summer of next year. Well, that would mean that some other asset classes are dumping and that there's still a flight to safety in the dollar. But that would only be short-lived, and you might get like a double or triple top, and then eventually by spring of 2024, you would see finally the capitulation of the dollar into weakness and an asset boom. Also, in purple, we have another fractal that comes off of 8% drops on the dollar historically. That would imply that you get a small bounce that gets completely reversed to new lows and starts trading in a new range somewhere between the 94 level and the 102 level. And these levels are based off this institutional wick here, double wick pattern. And the reason why I think that this is a possibility is because there are certain signals coming in on like gold and bonds and crypto that is showing that there could be a short-term bottom in play before a big spike back toward dollar safety and then finally capitulation.
Yeah, and fundamental being that the Fed's at the end of the rate hikes. That's what the whole thing. People always ask me what came first, technicals or fundamentals. I said, apply the same to the chicken or the egg. Yeah. You can always find a fundamental reason for a technical move. I agree with that. The dollar, I have support around 103.5 on the March contract and a high of 109.10. So we can back and fill in there because this is going to take some time, like Mitch said, to play out. But I think the dollar has turned, from the upside to, there's a tremendous amount of consolidation if you drew a couple horizontal lines between those, channels. So we could go back again into the channel, into the mean. The question is, what if it doesn't hold it?
Yeah, and so then that's where you get this third red line, which would be something sort of on the premise of dollar destruction, where you see a complete mass exodus from the dollar, foreign governments completely abandoning U.S. sovereign debt, and pretty much just an abandonment of the Fed because of a lack of trust. And I'm pretty sure it was David in there earlier that said, who trusts the Fed anymore, after the things that they do and they say and the insane monetary policies. And so, this is always, you have to be cognizant of that this is a possibility. And if that were to happen, you could see the bottom on crypto, the bottom on some of these other assets quicker, and just a complete exiting from the dollar. So not to say that any one of these three outcomes is going to happen for sure, but just that this is your projected ranges as we ultimately will trend toward the bottom of this uprising channel.
And, that was a great point. It's based on, the only thing that gives value to any asset is what people want to pay for it. And the dollar, since it's off the gold standard since 1974, it's just the fate that our government's going to pay its debt. speaking of debt, look at the consumer now. They're running historical amounts of debt right now, and all that money, there's still that money still out there, but it's going to be gone in 6 months. So the Fed will have done its job and eliminated the liquidity that it printed up during COVID. But then what's the catalyst going forward?
So here's your money printing chart, Bob, to continue.
Yeah. So, this is a great chart. The chart itself is M2, and that's basically the amount of money that the Fed printed up between COVID. And you could even go back to 08, because there's been 3 events where the Fed has printed money. Again, in 08 to save the banking system. And a lot of people aren't aware of it, but a few years back, it's raising its head right now is the non-bank investment dollars. And that's
and this comment here, that it's just basically, the point is that the Federal Reserve's balance sheet ballooned during 2020, and that's this huge spike in liquidity. And so what the Fed is trying to do right now is as you see that this chart is starting to roll over and go bearish, what that actually is meaning is dollars are being pulled out of the economy. And where are they going? Well, they're not going into the economy. Okay, they're getting probably dated.
What the Fed has done, and that's been their game plan, they were going to start by reducing their book from, again, 08. They had a lot of assets that they said they'd buy and just sit on them. And then when the markets recovered, they'd be able to sell them at a profit. And they did a pretty good job when they started to. However, once they started unloading it, then you had, the next COVID happened. Well, now they got to run the pumps again because of another crisis, and we'll just keep fattening our book up and to keep, people employed. Yep. Again, they've done that so often.
According to this chart here on the left, it's basically saying that as of November 1st of this year, the Fed's balance sheet is $8.68 trillion. That's almost half of the entire liquidity pool of dollars out there. So they are able to backstop in so many ways, and that will become very clear when we look into the bonds charts.
And again, the other aspect you got to keep in mind, the Fed's inflation rate is supposed to be 2%. We're burning at 7.7% now. So what's going to, again, demand destruction is what he's going for. And people just got to, stay, conservative, because he wants to shrink this money out there. And it's not going to be pretty. I don't think next year's going to be pretty. That's my personal opinion, because people can't even make up their mind if you're in a recession yet. But it's happening.
We'll have charts. We'll have charts, yeah. And when we get to the yield inversion part, that'll prove that a recession is coming. And I just wanted to, we'll pull up this chart, or this question here, or this comment from Wake Dog. He says, funny how we had a revolution over 3% tax in the 1700s. Now we're 10x that. When revolution? When's the revolution? And, to answer that question, I don't think that we live in the same United States that we lived in the 1700s. I don't think people really understand how complexified the system has gotten, and the truth of how law and finance works. And that's kind of working against us. So we blame each other, we blame some entity, but ultimately we need to come together and understand this stuff. This is why we're doing what we're doing today.
Yeah, Access Live. The other thing is, and this is why we met, and what I was driven by is the technology. I'll never forget that, if you don't mind me telling a quick story. I met, Access Alive at work, and he was a miner. And I'm like, what, you digging for gold? And and he's like, yeah, in a way. And then once I found out about it, I'm like, I know what my background was. I'm like, all right, what's the investment opportunity? Because I said, that's a lot of work. And I go, who makes the chips? NVIDIA. I go, well, I'm just going to buy the guy at the top, and then I'll participate in it without, half the work. So I'm a believer.
Max, isn't that what, how does that saying go about buying the pickaxes instead of mining for the gold or whatever?
Yeah. The gold rush, the people that sold the equipment made the money, not the people digging for the gold. So, and that's all we're trying to do. This is what I'm trying to do. You know what? I don't need the whole pie. Just give me a piece. I'll share my information with anybody who's interested. And, that's what I like. This information we're providing, do your own homework. I encourage homework. because you got nothing but time now. Again, I'm in crypto too myself. I have positions on, and it's just going to take time to play out. This is what this presentation is about. We're explaining a broad view of the economy and money. At the end, it's about liquidity. And without it, again, FTX, all these other types of explosions we've seen are going to get more intense next year. Again, because the cost of money has gone up so dramatic. A lot of these techie companies, they're heavily debt financed. So when their debt is up for renewal, they're going to have to lock in at higher rates. And if they don't have the cash flow, they're out of the business. And again, that's the similarity of the .coms. They did the same thing. They were all moving out of garages, going to get into fancy office spaces because the internet was taking off, Y2K, and
all this. Yeah, exactly. I think that those cash flows come from innovation. They don't come from making a new iPhone that does the same thing every year. They don't come from Facebook, which is a platform that's been around for over a decade now and hasn't really innovated in any meaningful ways recently.
Yeah, but it gets back to also how the government perceives how to take care of us. Because of Y2K, they really, I know we got some younger viewers there, but people thought every computer was going to crash as soon as we went from 1999 to 2000. It had never been tested or anything. And so the year
Max and I were still in 5th grade.
Yeah. So get this. Before, everybody was coming up with all these consulting firms to make sure your software, your computers will reboot New Year's, and the Fed was worried. So they, again, pumped money into the economy just to make people feel good because everybody was panicking. Businesses were spending all this extra money just in case. Think about it. If their systems went down tomorrow, you have chaos. So that's what the real fear was in 2000. And then when nothing happened, everybody's like, what the hell did I just spend all this money for?
What it really was a lack of education and a lack of understanding technology. And that's ultimately...
The technology was at its infancy, Mitch. That's what I'm telling you. And that's what I've said. There was a lot of stocks that were high flyers, just like, these crypto coins. And at the end of the day, my question to anybody who questions that, it was a terrible time, but is the internet still here? Because they were saying the internet's gone after the .com. And that's BS. And the same thing with this crypto. What it's doing, and we just demonstrated in the process of not only government releasing information and everything else, why not do it again in a blockchain scenario where everybody gets it at the same time, nobody can regulate it, and there'll be better efficiencies. But I'll get off my tangent.
This is a good point here by PulseChain Trainer. He asked the question, if quantitative tightening ends and quantitative easing gets turned back on, do you still feel the recession will carry through 2023?
Yes. I'm even looking till almost the second half of 2024. We've had, just look back in the last 4 years, we've had phenomenons that, are historic in nature, from, again, locking, world down to printing endless amounts of money to encouraging, just think when we all opened, it wasn't just the consumer, it was businesses, it was governments, and you just can't drain a system that fast. We're a world. I mean, it takes time, the logistics to move stuff. And that's why inflation was a guarantee. And it's not going to go down. I personally believe that this is not an issue that the Fed can fix. They got a lot of creditability issues.
This chart here is going to try to explain what Bob's saying. And when you see these huge sections of lots of red candles pushing down quickly, those are massive inflation periods of history. So this was in the 80s. This was after the .com bubble. And most recently was the COVID. So what this chart measures is the value of the dollar relative to the supply. So when the supply gets increased at a rapid rate, you get massive inflation. And so then this stuff takes time to work through the system. That's what these sideways, and I'll pull up this chart now, these sideways arching parabolas, these are the times when inflation's trying to recorrect. And this is when policymakers, maybe raise interest rates or increase taxes or use one of the levers of the Fed power to try to fix the inflation problem that you see during these huge green spike downs. So we've most recently went through a huge green spike down, and what this is trying to predict is how long could this period of recovery take? And this is saying that this is till 2030 at least, and that can just be that's like a time frame.
You're
roughly.
optimistic. You call that a recovery. I said, how long until it bottoms is what I would say.
Yeah.
But yeah,
Well, this chart never bottomed.
yeah. I mean, it's exceptionally lower. You know what I'm saying?
Yeah. Well,
Yeah.
my point is that the dollar's doomed and the Fed's doomed to always have to print money. So we're trying to find where are the safe plays, where's the technology, where's the innovation, where can we hedge and save ourselves and be defensive in these times. And so now we'll get into the basically the bond market and again to explain, where's the money going. We showed you how the dollar was reversing. So where's the money going? So I just give you
Not only where it's going. I would say the other indicator that this is going to let you know about is just how severe and historic these events that we're in right now are going to take time to play out. I mean, that's what I wanted to put in perspective, that people are going to be scared when some of this stuff comes to fruition, like people get laid off. Again, it's already happening in the housing market. Building construction and new permits are down like 30% already. So it's going to have a devastating impact on more sectors as we go.
I just noticed something by looking at this chart, and I just want to point your attention here. If you see down here at the bottom where my cursor is circling 2014, that's roughly when Bitcoin topped and started its bear market. And if you notice, the dollar plus supply rose during the time of a crypto bear market. And then when it peaked, it was actually the bottom of the crypto bear market on Bitcoin. And Bitcoin created its giant parabola run up from $200 to $20,000 in 3 years. And if it's funny because it's an inverse relationship between what this chart's doing and what Bitcoin was doing at that time.
Well,
So we
again, but
can,
that's Mitch. That's true with a lot of asset classes. When
sure,
the
I'm just
dollar's
using
up,
Bitcoin as an example. Yep.
yeah,
During this time, money flows back into assets, is my point.
yeah.
We were to the top of the channel here, and it's made its first red candle. And so I'm of the belief that we're in for a very volatile 2023 and into 2024. And then as the inflation metrics correct and pricing gets back to baseline levels, that's when you start to see money flow back into assets. So
Yeah.
I'm getting like a 2-year time frame roughly.
Yeah, because in essence, if you look at it, it's, what the governments are doing is now when everything opens up again, because China's coming online again, that demand's going to be restricted by the cost of money. So
Yep.
that's why they're regulating it. And again, look at it, the dynamics from COVID, everybody opening and going with all this money. You had to regulate it. It's got to be regulated. It's just like, unclogging the toilet, right? You get the heavy stuff out of the way, and then you're bad
Get some
analogy.
running water again. Yeah, and it makes
Flush,
sense.
flush, and pray.
So what is a yield curve? Well, a yield curve graphs the relationship between the bond yields and the bond maturity. So the way bonds work is you can purchase a bond from the government basically on a monthly, quarterly, bi-yearly, yearly, 2-year, 10-year, 30-year. You can buy these bonds that mature at a different rate, but the reason why you buy the bond is because it pays you to hold it. Just in the same way that Hex, when you stake it, pays you to hold it. But in this system, the US bond system, each type of note gives you a different yield. So a 2-year yield might be 4 point some percent right now, and a 10-year yield might be 3.7% right now. But what that is it's inverse of what it should be. In the same way that Richard Hart created Hex so that the longer you stake, the more you earn, it guarantees that there is no yield inversion into the system, which is not a guarantee in the Federal Reserve System because that system does invert in its yields. And there are periods of history where they have to go into rate hiking and other sorts of levers of the Fed, of the power that they have to try to correct that yield inversion. So
an inverted yield curve basically represents a dysfunction in the credit markets. Generally, you want to be paid more for the future of money because, like we said earlier, future dollars are worth less than today's dollars. So that's how they compensate it with interest rates. But again, the longer the lockup period, the maturity period is, the higher the rate. That's the normal economy. Now that it's inverted, nobody wants to take the risk that far out. So they move to the short end of the yield curve. And that's why, your 2 years right now are at 4.4%. and the 10s are 3.6, and then the 30 years are 3.52. So it doesn't make sense. Why would I lock my money up for 30 years and make less on it? So that's what's meant by an inverted yield curve. It's back assward. And what it means, though,
Here it
is
is on
this.
the left here. We can see that, okay, on the bottom axis, you have a 1 month note, 3 month note, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 20 year, 30 year. What this chart should show, it should be like a parabola, so that the longer you lock your money up with the Fed, the more yield you're going to get for taking more risk and putting your money out into the future.
And let me expand on something really quick. It's just not government bond. Any debt is structured this way: corporate debt, municipal bond debt. That's the principle. The tie-up period represents higher rate of return.
So if I go into the bank and I want to buy a house and I want to get like a 30-year fixed mortgage rate, they'll fix it at a lower rate than if I do a 7-year mortgage rate, right? Theoretically, under proper economic conditions. Am I right about that?
Say that again.
If I go to the bank and I want to buy a house,
Yeah.
and if I do a 30-year fix, the interest rate should be lower than if I go and want to do like a 5-year.
The interest rate will probably, yeah, well, depending on, how it's structured, but generally, like a 15-year, what happens is you may get a lower rate, but they want more principal paid back because you're paying it back in less time. You know what I'm saying?
Yep. So there's different variables that plays into this.
Yeah. So you can't just look at it as a differential in that regard.
But for ease of understanding for our viewers, I think it's important to just note here on the left that in the short term, look at how much you're getting paid to lock your money up for 1 year or 2 years. To use just common vernacular of crypto folk, you lock your money up for a couple years in a bond, you're getting paid more than if you lock it up for 30 years. Well, that doesn't sound very good.
The only investor that this benefits since 2000 was the last time seniors could get a positive rate of return on their CDs or T-bills, which is basically an investment in government treasuries for 90 days. You can do 6 months. It's variable maturities. But 2000 was the last time they actually, after taxes, got a positive cash return by investing it. But it was very safe. Again, it was guaranteed. Today, the I bonds, which again has been an instrument that was created since the last inflation, where it actually keeps up with inflation, where other debt doesn't. So these I bonds are paying an incredible rate of return right now. That's guaranteed for you could buy it for 5 years. So these seniors that need income, that's why I said, depending on what your risk tolerance is and what your age is, you really have different styles because you're investing for different reasons. Seniors for the last 20 some years were forced into the riskier side of the portfolio because they would either eat up their principal or they could never make as much a return on their investment in typical finance, like bonds, the debt market they call it, because yields went down from 2000. We went negative interest rates. So on a huge sector, fixed income, got decimated during that if you needed it for income. This is the first time in 22 years that is reversed. So that's pretty huge. And I think that also tells you free money is not coming back. That was the extremes. And I think we're going to go back to the mean. And we all know charts and patterns. You get extreme conditions, but you come back to the mean. And that's where we are in interest rates right now. If we're at 8%, interest rates, that's not historically, that's the mean historically. We just, again, went from negative to where we are now in 8 months, 9 months. That impact on the world economy, shutting it down, it might as well be COVID. That's what I'm seeing in my charts and everything. What we're going to experience next year is going to rattle some.
So, I'm just going to use the mortgage rate chart here for a second to show you guys what he means when he says the mean. Basically, if you found that moving average up here, let's just pull up an average. Let's do like the 1,000-day average. Something. That's too much data. Let's do 500. So yeah, look at this yellow. This is the 500-day moving average over this chart. So we're almost to the mean on that 500-day moving average. But meaning that this middle green line is basically, over the history since 1971, mortgage rates are almost at that middle point. which was also
8%.
Yeah, which was that key breakdown point that we had in 2000 when we had the dot-com bubble, with everything that went on with that. So, and then this chart here shows like the spread between the Treasury yield. So what this is saying is that right now the yield curve is inverted minus 0.82%, and that we haven't been this low on this chart since the 80s when we had the crisis of the 80s. I don't know if you wanted to expand on that quickly. But this inverted yield curve has predicted the past 7 recessions. So we weren't even this low in 2000, pre-2008. We weren't this low before the dot-com bubble in 2000, nor were we this low in 89. It was in the early 80s that we had this type of action in the bond market.
Yeah, and can I just interject again? I don't know if anybody knows Peter Lynch, but Magellan Fidelity. He's a great guy to read up on because he always just looked around his environment for his investment clues. And during each of these events that you just covered, when you get these huge shifts in again, especially in economies of the world, and I believe that's what's happening now. I remember in the 80s, interest rates in 1977 were 15%, short-term rates. And they went from 15, and everybody's businesses like insurance and life insurance, and also if they had a part of them, they come up with policies that invested in the stock market and stuff. But they all assumed the rates would stay high. So when the rates went down to zero, how many of these financial companies lost because they had to made right by the investors, because they was sold on promises on again, maps or studies of the last 10 years, but nobody had taken rates to that low based on the parameters of the data they were looking at. So we've had extreme moves, and I think now we're getting another shift. The shift is it's not free money anymore, and everything's assets got to
free money is represented here in this chart on the black line here. We're between 2010 and then if you take away the few years prior to the 2020 crash. I mean, money's been free down here for about a decade, relatively.
I'd say 20 years. Yeah. 20 years.
So I mean, what that means is that
2003.
It comes back to my comment about the zombie economy. What free money does to a society is it makes us weaker, dumber, and less obligated to go out and produce innovation. That's what it does.
It also makes you addicted. Think about it. It's a social thing. You lock people up, you give them all this money. It's money. That's the only, we've been programmed to.
You can't eat money though. You know what I mean? Like,
no, I understand, but Mitch, my culture was growing up. Hey, if you don't feel happy, go shopping, go shop, and now, people have the ability after being locked up for 2 years. I mean, I get it. I think the government was irresponsible by printing money but I understand why they did it, but they didn't do it in 2008. It didn't work. It probably would have worked better in 2008, but that's what they didn't want to have a repeat 2008. So they tried this to print money. I just think the effects of this is going to be worse than what 2008
Well,
did.
They've eroded confidence in the Fed.
Yeah, and that's the scariest thing that's going on now. People are losing faith in the Fed. And if the Fed doesn't have any, political might anymore, again, what is currency? What is an asset? It depends on what we value it worth. And that's why I say it may move out of the hands of people and into systems like, the technology of crypto, I believe.
Yeah.
FTX didn't fail because of crypto. It failed because of a corrupt CEO.